Good morning. This is Unit 1, Portfolio Construction. At the end of this class, you will be able to know what is the meaning of portfolio, risk and return analysis, relationship between risk and return, and the various types of risk present, and methods to calculate the risk and return. Meaning of portfolio management. So we'll look into the term portfolio. So it's made up of two terms. One is port and another one is folio. So here port means group of and folio means number. Say suppose for example, I have 50 lakhs with me and I want to invest that amount. Here 20 lakhs I'll purchase the land, 10 lakh I'll purchase the gold and 5 lakhs I'll deposit in post office and another 5 lakh I'll invest in shares and 10 lakhs I'll keep in bank as FD. So this way of diversifying the funds available with me in different places is known as portfolio. And managing these investments with the help of right tool and strategy to achieve maximum returns and to reduce the risk within a given time period is known as portfolio management. So professionals in portfolio management say that all eggs should not be kept in a single basket. That means the funds available should be diversified at various places. So that is the rational investor will invest the funds at various places to achieve the to reduce the risk and to maximize the returns. Risk and return analysis. So here risk means it's a possibility of suffering some loss due to future uncertainty. So we all know that future is uncertain and it may lead to some differences in the actual return when compared to the expected return. So that difference or that loss which occurs due to future uncertainty is known as risk. For example, if I have 1 lakh and I want to invest it in bank as a fixed deposit. So here is a chance that I'll get some interest for 1 year, say 8%, and as it is secured, the risk here will be 0%. Say suppose the same amount if I have invested in share market, then there is certain portion of risk wherein the future is uncertain, the market is uncertain and it will, as the rates will change, so the risk, there is a certain percentage of risk. So that is, risk is nothing but there is a possibility or chance of suffering loss due to the future uncertainty. Next, coming to the return. So it is a gain generated from any investment or the final outcome of investment made in purchasing the securities. So it may turn out to be profit or loss depending upon the market scenario, but certain percentage you are going to get return. So if the say I have a project and I have invested in that project, say 10 lakh, and in return I may get the return as a certain percentage depending upon the market scenario. Here I can say that these two are interrelated So when the risk is high, then the return will also be high. And when the risk is low, then the returns will be less. Coming to the relationship between risk and return. So greater the risk, greater the expected return, and vice versa. So when the risk is high, then the return will also be high. And when the risk is low, then the returns will also be lesser. So here, as both risk and return, they are going in the same direction. We can say that there is a positive relationship between the amount of risk assumed and the amount of expected return. So here in the graph, you can see that risk is on x-axis and returns are on y-axis. So bank deposits is a secured place wherein the risk is low and the return will also be low. Then coming to the public sector bonds or corporate bonds, so medium risk will be there and the returns will also be to the minimum or medium. Next, mutual funds, equity and venture funds. So here highest risk is present in venture funds wherein the return will also be high in the long run. Types of risk. There are two types of risk. One is systematic and another one is unsystematic. So systematic risks, these are uncontrollable by the company. So the factors which are external to a particular company is known as a systematic risk. Say for example, the demonetization of currency which affected the whole nation, and even the present COVID effect on various nations. So this comes under systematic risk. Coming to the unsystematic risks, these are particularly, specifically these are unique and related to a particular company. So these are specific, unique and related to a particular company. So for example, like business risk or financial risk, or you can take if the relation between the labor and the management is not good, then that will affect the company's performance. Ways to calculate risk and return. So the various ways to calculate risk and return are: for risk, there is a standard deviation and a beta, whereas return is calculated through periodic return, arithmetic return, and geometric mean return. Coming to the investment objectives, a rational investor wants to maximize his returns and minimize his risk. Here, investment means not only getting the returns, not only expecting the returns, but also the growth in that particular investment or in the asset. That means capital appreciation. So after a certain period of time, its value will get increased. So that is nothing but the capital appreciation here. That means an investor will be looking into the returns, maximum returns, as well as the asset growth or capital appreciation, and he will look for the minimal risk. Risk cannot be avoided, but it can be minimized by diversifying the investments or instruments at different places. The risk can be minimized. Next, risk return trade-off. It is one of the trading principles that links the high risk with high reward. The risk return trade-off depends upon a number of factors including the investor's risk tolerance, how much he is going to tolerate, and when he is going to retire, the number of years to his retirement, and the potential to replace the lost funds. So here time also plays an essential role for portfolio determination with the appropriate levels of risk and as well as reward. Say for example, an investor he will invest in equities over the long term, that is in capital market, that provides investors to recover the risk, like where whenever the market is going bear markets, that is downtrend, and participate in bull markets. While if an investor can only invest for a short time period, then those equities have a higher risk proposition and he has to bear that risk. So here it depends upon the time whether he is going for long term or short term. So if he is going to for long term, then he can able to recover those losses or risk, and he can invest in some new securities. So this is about risk return trade-off.